Hello and welcome to Session 1 of the Basic Tax course. We begin Session 1 by learning about who must file a tax return. I have students who are in my classroom as well, and you may see me periodically communicating with them. I will always verbalize what it is that their question was, so you're not left in the dark. And we're now going to begin with the lecture, which is, of course, filing requirements and who must file. Now, Pub 17 contains a series of tables. There are a total of 3 tables in Pub 17, and IRS says you're required to file if you meet the conditions shown in any of those tables. The first table is the table that impacts most filers, and this table is simply based upon your filing status and your age. And it asks, what's your filing status, what's your age, and how much money did you make? And if your income is at least the amount shown in this column based on your age and filing status, then you are required to file. So for a single person who is under the age of 65, the filing requirement is $9,500. That same person, if that person becomes age 65 or older, then the filing requirement moves up by $1,450. And a person who is single and age 65 or older is not required to file until they earn $10,950. We move down the list, and we'll see that if you are under age 65 and married, the filing requirement is $19,000. And where did that number come from? Well, it's twice the filing requirement for single. So it's actually pretty easy to remember. If you know the filing requirement for single, you've got the filing requirement for married filing a joint return in most cases. But I did want to point out a couple of oddities in here. If you see here it says married, living with your spouse at the end of the year or on the date your spouse died, the filing requirement is actually a pretty high number, and it keeps going up based on age and whether one or both of you is age 65 or older. But then it says if you're filing a separate return, your filing requirement drops to only $3,700. Similarly, down here it says if you're married and you didn't live with your spouse at the end of the year, whether you file a joint return or a separate return, your filing requirement is again $3,700 regardless of your age. So there's reasons and calculations about where these filing requirements came from, and we're going to move on to the next page of our manual to see how it is that the IRS comes up with those seemingly random numbers. And they all revolve around something called the standard deduction. And the standard deduction is such a simple concept, you might ask, why am I even going to spend time talking about it? But actually, the standard deduction factors into filing requirements, so it's a very important concept. Also, there are rules about who is allowed to claim a standard deduction, and I'm going to discuss those with you now as well. So your filing requirement is generally tied to a combination of your standard deduction and your personal exemption, which is $3,700 for 2011, if you are allowed to claim it. Each of the 5 filing statuses is generally entitled to claim a standard deduction, and you should claim the standard deduction if it is higher than your itemized deductions. But there are certain cases where you either are not allowed to claim a standard deduction, or you may decide you would rather not claim the standard deduction, even though the standard deduction is higher than your itemized deductions. So here are some reasons why you should not or would not be allowed to claim the standard deduction. The first one is if you are married filing a separate return and your spouse itemized his or her deductions. Well, that would be quite simply the reason why, if your filing status is married filing separate, that your filing requirement would drop to $3,700, because $3,700 is your personal exemption. And if you file separately from your spouse, you're allowed to claim that, but you may not be allowed to itemize. And so your standard deduction is not a factor in determining filing requirement for the filing status married filing separate. Another reason why you can't use the standard deduction or may not use the standard deduction is you are filing a tax return for a short tax year because of a change in your accounting method. Well, that's a pretty rare thing. Next, you are a non-resident or dual status alien during the year. You are considered a dual status alien if you were both a non-resident and a resident alien during the year. So essentially, non-residents who file Form 1040-NR are not allowed to claim a standard deduction. They are required to itemize. You are allowed a higher standard deduction if you are age 65 or older. You are considered to be 65 on the day before your 65th birthday. Therefore, you can take a higher standard deduction for 2011 if your 65th birthday is on or before January 1, 2012. You are allowed a higher standard deduction if you are blind. You are considered to be blind or partly blind if you cannot see better than 20/200 in the better eye with glasses or contact lenses, or your field of vision is not more than 20 degrees. So what this is saying is if you've got absolutely terrible eyesight, but you can wear contact lenses or glasses and you can see again, you're not going to be considered blind. Even though without the glasses, you are technically legally blind. Once you put them on, you're no longer blind. So IRS does look at that in determining blindness. But you should note that even though I've just finished telling you that your filing requirement is tied to your personal exemption plus your standard deduction, the extra standard deduction for being blind does not factor into an increase in the amount of income you're allowed to claim before you're required to file. So if you go up here and look at this chart again, you can see that the amount of income you're allowed to earn before you're required to file goes up when you turn age 65, but does not go up because you're blind. So you can technically be blind and age 65 and have a larger standard deduction than the income that you have that requires you to file, in so many words. Now let's go and look at the next category, which is the standard deduction for most filers. Most filers who are single get a standard deduction of $5,800. For married filing joint, you double that number and you get $11,600. Married filing separate is $5,800, the same as single. Head of household is $8,500, and qualifying widow or widower with dependent child is $11,600, which is the same as joint. The additional standard deduction if you are age 65 or older or blind is $1,450 for single and head of household, and $1,150 for married filing joint, married filing separate, or qualifying widow filing statuses. And here's an example of how this works. Max, age 64, is a single filer. He is required to file a return if his income is equal to or greater than the combined total of his standard deduction plus his personal exemptions. His standard deduction is $5,800, and his personal exemption is $3,700. He is required to file a tax return if his income is equal to or greater than the total of those two numbers, which is $9,500. So I've come up here with a quick class exercise just to test how quickly you've grasped these pretty elementary concepts. Determine the filing requirement for each of the following taxpayers. And all of you who are with me today in the webinar and in the classroom, we can just work on these together. Let's look at problem number 1. Martha, age 65, is married to Samson, age 70. They had $16,500 of pension income and $4,000 of interest income. Are they required to file a tax return? So are Martha and Samson required to file a tax return with the level of income you see here? Madeline says no. Who else says no? Does anyone say yes? Who has no idea? So this is the part where, as an instructor, I test to see if you are actually paying attention to me, because we're just deciding today whether or not our filers are required to file at all. And if we can't figure that out, maybe it's time to find a new line of work. So let's go back to the beginning. You're required to file a tax return if your income is greater than your standard deduction plus your personal exemption. How much is the standard deduction for married filing joint? And how much are the personal exemptions that two filers filing a joint return would get? So essentially, to determine the filing requirement for these filers, we're going to do this. We're going to take the standard deduction that we see right here, $11,600 for married filing a joint return, and we're going to add $3,700 twice. What happens when we add all of those numbers together? So we're going to go 11,600 plus 3,700 plus 3,700. And what do those numbers total? Who has a calculator and can tell me? Well, to help you out, I'm going to ask you to look at the very back of the manual where I've put an answer key. And the first password for session number 1 is Arabian. Arabian. The answer key is actually on page 41. So I'm just going to type page 41. We'll jump to it real quick. Here we are. So we calculate Martha and Sampson filing requirement as follows. We take the standard deduction for married filing joint. We also take age 65 plus the standard deduction for Martha, age 65 plus for the standard deduction on Sampson. We also take personal exemption Martha, and we take personal exemption Sampson. And we add up all of those numbers and we get $21,300. Then we say, how much income did they have? Well, they had $16,500 of pension, $4,000 of interest. That gives them total income for the year of $20,500, which is less than their filing requirement. So the answer is no. They're not required to file a joint. They're not required to file, period. All right. So I've already challenged you in the first 5 minutes of this class. Let's go back up to the top where we were and see how we do with the next question in line. Now that you know where the answers are, no cheating. So question number 2, Jocelyn is married to Mark. Jocelyn lived in Canada all year while working at a university in a 2-year research project. Mark remained in the United States. Jocelyn and Mark will file a joint tax return. What is the maximum amount of income they can make before they are required to file a tax return? So this is an open-ended question. It's not just a yes or no question. What is the maximum amount they can make? The answer is $3,700. Let's go back up to the filing requirements on the first page here. It says, married, not living with your spouse at the end of the year, you are required to file an income if your tax return if your income is at least $3,700. So that's the answer. If their income equals or exceeds $3,700, they're required to file. Next question in line, number 3. Peter's wife died in 2010. Peter, age 52, maintains a home for himself and his qualifying child, Zach. Peter's only income for the year was wages totaling $14,900. Is Peter required to file a return? So what we ask ourselves is, what is Peter's filing status? Well, he maintains a home for himself and his qualifying child, Zach. So I'm pretty much giving you a big fat hint here that his filing status is going to be head of household. So you're going to start with $8,500, and what's the number that we're going to add to that to determine whether or not he's required to file? $3,700. So the answer would be $8,500 plus $3,700, and if we go back up to that first table, we're going to see that the filing requirement for head of household, where are we? Single. Head of household under age 65 is $12,200. There we have it. Okay, now you thought that was challenging. Wait till we get the filing requirements for dependents. So we're going to move on to the filing requirements for dependents now, which is table number 2 from IRS Pub 17. The filing requirement rules for dependents are different than for non-dependent filers. If you are a dependent, your personal exemption, that $3,700 number, will be claimed on the return of the filer who is claiming you as a dependent. Therefore, you determine your filing requirement by determining your standard deduction. Now, if your parents or someone else can claim you as a dependent and any of the situations below in this table applies to you, you must file a return. But in looking at the table, we also have to take into account the kind of income that you, the dependent, have. Firstly, we have to look at whether or not you have earned income. And in this table, earned income includes salaries, wages, tips, and professional fees. It also includes taxable scholarships and fellowship grants. Unearned income includes income from interest, dividends, capital gains, pensions, annuities, rentals, unemployment compensation, taxable Social Security benefits, and distributions of unearned income from a trust. So we have to have an understanding of the difference between earned income and unearned income before we can determine the filing requirement of a dependent. Once we understand the difference between unearned income and earned income, we move down and take a look at the table. And I'm just going to zoom in a little so it's easier to see what I'm talking about here. And the first category is a single dependent. Were you either age 65 or older or blind? If the answer is no, you must file a tax return if any of the following apply. Firstly, your unearned income was more than $950. Okay, so what that's saying is you're allowed to earn up to $950 before you're required to file, but it's possible you might be able to earn more because let's look at the next bullet. Your earned income was more than $5,800. Well, what's $5,800 in terms of a single person? That's the maximum standard deduction a single person can claim. So what it's saying is that as a dependent, you can have a job and earned up to $5,800 before you're actually required to file. Your gross income was more than the larger of $950, or your earned income up to $5,500 plus $300. So this is making it a little bit more confusing, and this is why the filing requirements for dependents are confusing, because you're looking at really three rules. The first rule is, did you earn more than $950? The second rule is, did you have earned income that was more than $5,800? Because if you have earnings of more than $5,800, you're required to file. And then finally, we look at the total income you had for the year. Was your gross income larger than $950, or your earned income up to $5,500 plus $300? Well, what's $5,500 plus $300? $5,800, right? So really what we're looking at here is $5,500 plus $300. So your earned income up to $5,500, that means as a dependent, I can go out and get a job over at the bakery at my local supermarket over summer, and I can earn up to $5,500. And in addition to the $5,500, I can have up to $300 of additional income. Now, what if I earn less than $5,500? What's my filing requirement going to be as a dependent then? Let's say I have a job and I earn $3,000 at my job. How much more income can I have above and beyond that $3,000 from my job before I'm required to file? How much? $300. $300. So we're looking at earned income plus unearned income. And the most unearned income I can have is $950. But I may not be allowed to have as much as $950 if I also have earned income, and my earned income takes my total income above $950. If my earned income plus my unearned income goes above $950, my standard deduction as a dependent will equal my earned income plus $300, but never less than $950. What? Now, I've been teaching filing requirements for dependents for the last decade. And I've literally had students burst into tears trying to understand this. So if you're confused, that's a normal way to be. But that's what I find so humorous when people talk about tax law, and some people walk around thinking taxes are simple. And they've been doing taxes for, 15 years, and then they walk in and they flunk a test because they don't know filing requirements. So, and filing requirements are key. You have a client who comes in and sits down across from you and they say, yeah, I need to know if I need to file my tax return. You should be able to answer that question. Do you need to file or not? So you've got a client and he's got a kid that got a job over summer. The kid's 16 years old, got a job over summer, and the client asks you, does my child need to file? Well, you need to know the rules for filing requirements to answer that question. So let's move on and see what else this has to say. The next point it asks is, you also must file a tax return if you are age 65 or older and you have a little bit higher income, because this rule up here is your unearned income was more than $950 or your earned income of $5,500 plus $300. But if you go down to the next category, this is for people who are age 65 or older. And in this case, your unearned income can be up to $2,400. Well, where did $2,400 come from? Age, it is associated with age, but what number did we add to what number to get 2,400? Chung. Who can answer the question? The answer is the additional standard deduction from being age 65 or older is how much? When you're single, $1,450. $1,450 plus $950 equals $2,400. Oh, and what's this? Make it $3,850 if you're age 65 older and blind. Now, didn't I just finish telling you that blindness was not a factor in filing requirement? But that was for people who are not dependents. If you are a dependent, blindness can be a factor. So when you're looking at the filing requirement for a dependent, you look at $950 for all forms of income. You then look at earned income up to $5,400 or $5,500 rather, plus $300. And then you also look at age and blindness. And for age, if you are not married, you get an extra $1,450, and if you are blind, you get an extra $1,450. If you are married, and it is possible to be claiming an exemption or a dependency deduction for a married dependent, then that married dependent's filing requirement would hinge on $950 plus $1,150 plus their earned income up to $5,500. See what I'm saying? Now, in order for this to actually sink in and make sense to you, you probably need to work through a couple of illustrations. So, of course, I have some of those in here for you. Let's move to the next page and look at some more verbiage and some more examples, and then I'm going to have you work through a couple of illustrations on your own. So the standard deduction for dependents. If you can be claimed as a dependent on another person's return, your standard deduction is limited to the greater of $950 or your earned income for the year plus $300, but never more than the regular standard deduction amount, which for most filers is generally $5,800. Note that if you are a dependent who is age 65 or older or blind, you may increase your standard deduction for each of these conditions as follows. $1,150 if you are, oh, I got this reversed, $1,150 if you are married, and $1,450 if you are single. I typed that sentence backwards. I'll fix it in further revisions of the manual. Sample, or example. Samantha, age 66 and blind, is married and will be filing a separate return. Her spouse will not be itemizing deductions on his separate return. Samantha's only income for the year included $5,000 of non-taxable Social Security and $3,000 of pension. Samantha lived with her daughter Lisa all year. Lisa supplied more than half of Samantha's support and will be claiming Samantha's dependency exemption on her return. Calculate Samantha's minimum standard deduction as follows. We take $950 because that's the starting number that we always have for all dependents regardless of age. And then we add $1,150 because she is age 65 or older and she's married. And we add another $1,150 because she is blind and married. And we add those three numbers up and we get $3,250. So that is her minimum standard deduction. Now it could be more than that if she had a job and had earnings from a job, but this is the minimum that it would be. Samantha would be required to file a return if her income is greater than $3,250 as long as all of that income came from unearned income. And if she got a job, it could actually be more than that. And since her income is only $3,000, she's not required to file. Now, of course, I gave you $5,000 of non-taxable Social Security, and non-taxable income does not factor into filing requirement. You ignore it. The only number we look at is the amount of pension income she had, and it's less than her minimum standard deduction. Yes? There's a question in the classroom, and the question is, if I am a dependent and I am not required to file a tax return, do my parents need to put my income on their return? And the answer is absolutely not. None of us is ever required to put our child's income or anyone else's income on our tax return. The only exception to that is with certain flow-through entities. So if you have ownership in a partnership, S corporation, trust, or a state that is issuing a K-1 to you, then that K-1 would flow through income to you and you'd be responsible for the tax. But no, absolutely not. Even if you're married, you're not required to put your spouse's income on your return, except if it's community income and you are a resident of a community property state. And there are a few of those in the country. Let's look at example number 2. George is age 65 and single, and he lived with his girlfriend Jane all year. Jane provided the majority of George's support, and she will be claiming a dependency exemption for him on her return. Calculate George's minimum standard deduction as follows. We take $950, which is the starting point, and we add $1,450 because he is age 65. His minimum standard deduction is $2,400. He will be required to file a return if his income is greater than $2,400 and none of it is earned income. So I actually need to kind of correct the wording of this a little. If he has earned income, he could add up to $5,500 more income to his return, or to his filing requirement. But we're looking only at unearned income in this example number 2. And example number 3, Sally, single and age 18, is blind. She is dependent of her parents. Sally had earned income of $2,000 working at a part-time job. Calculate Sally's minimum standard deduction as follows. We start with her earnings, $2,000. And because we're using her earned income, we throw out that $950 figure and add $300 instead. So $950 is gone. In the other examples, you can see we had $950 because we were talking about unearned income. Now we throw out the $950 because we have earned income in the equation, and the total income is more than $950. So we take $2,000 of earned income and we add up to $300. Then we add $1,450 for being blind, and her standard deduction is $3,750. Her income is less than $3,700, so she's not required to file. All right, so just to see if you were paying attention, I now have a class exercise where I'm going to be silent for a minute and ask you to work through these problems. We have a series of 3 illustrations, and I'm going to take you through the first one, and then I'm going to ask you to complete the next 3 on your own. I'll give you about 5 minutes to work on them silently, and then we'll see what people think. Let's begin with the first one. Jack, age 15, is a dependent. He had the following sources of income for the year: wages of $2,000 and interest of $350. Is Jack required to file a tax return? Give me a green check mark if he is required to file. Give me a red X if he's not required to file. All right, so I've got a few people who say yes, he is required to file, and a few people saying no. So we have disagreement. Let's go back up to the table on page 6 of our manual. How old is our dependent? Is he under age 65? Yes. So we look at the equation here. Unearned income was more than $950. How much was the unearned income? $350. So we passed that test. Earned income was more than $5,800? No, it wasn't. It was less than $5,800, so we passed that test. Then we come to the third one. Your gross income was more than the larger of $950, or your earned income plus $300. Is $350 of unearned income more than $300? Well, $350 is more than $300, and that's why this dependent, Jack, is required to file. Jack had $2,350 of income. He is required to file. If he had $2,300 of income, he would not be required to file. Or if he had $2,300 of earned income and $50 of unearned income, he would not be required to file. It's the breakup of the income that is relevant here. And the unearned income, this interest figure, is more than $300. And when you add the unearned income to the earned income, we are more than $950. Jack is required to file. So let's move on to illustration number 2. Samantha, age 23 and single, is a full-time student and a dependent. She had the following income for the year: wages of $600 and interest of $350. Is she required to file a return? I'm getting mostly red X's. The red X's have it. Because $950, well, 600 plus $350 is equal to $950. It is not more than $950. And the filing requirement for dependents is the income more than $950? So we go up to the table again. Your unearned income was more than $950. No, it wasn't. It was how much? $350. Earned income was more than $5,800. No, it wasn't. Your gross income was more than the larger of $950. Was it more than $950? No, it wasn't. It was $950. So that dependent is not required to file. And the second password for session number 1 is Gypsy, J-Y-P-S-Y. All right, illustration number 3. So I'm going to let you take 3 and 4, and I'm just going to let you read them on your own and think about your answers. Okay, number 3. Who thinks Zach needs to file? Zach is age 65 and single, a dependent of his son John, and he had the following income for the year: wages of $1,200, pension of $1,600, and interest of $300. Is he required to file? Well, what's his standard deduction? Because his standard deduction is his filing requirement. If his standard deduction is more or equal to or more than his income, he's not required to file. And if his standard deduction is less than his income, he is required to file. So what is the standard deduction for Zach? He's single and he's age 65. So the starting point is to take his earned income, add 300, and add 1,450. When we do that, we get $3,200. Is his income more than $3,200? We've got $1,200 plus $1,600. That's $2,800. We add 300, and we have $3,100. His income is less than his standard deduction, so he is not required to file. Darn, this is too tricky. All right, next one, illustration number 4. Martha, age 20, is single and a dependent of her parents. She had the following income for the year: wages of $5,200 and interest of $300. Is she required to file? So let's go back up to the table. Remember that $5,200 and that $300, and look at the table. Is her unearned income more than $950? No, it's $300. Is her earned income more than $5,800? No, it's not. It's $5,200. Is her gross income more than the larger of $950, or her earned income up to $5,500 plus $300? No, it's not more than that. $52 plus $300 is $5,500 total income. Her income is less than her standard deduction. She's not required to file. All right, I did see a Skype earlier, and the question came from Damien. George doesn't qualify as a dependent, right? So let's go back up and find that question on George. Sometimes I see these Skype questions a little bit late. George, age 65, is single. He lived with his girlfriend, Jane, all year. Jane provided the majority of George's support, and she will be claiming a dependency exemption for him on her return. Calculate George's minimum standard deduction. Is there anything in the wording of this problem that would make you think that George's girlfriend could not claim him as a dependent? We're going to be moving on into dependency later in today's class, where we will cover all the rules for this, but I can tell you that in the wording of this problem, I've given you nothing to indicate that George would not qualify. And in fact, we'll learn when we get into the dependency tests that George would meet the test for being considered a qualifying relative. He lived with her as a member of her household for the entire year. She provided more than half of his support. His income is less than $3,700. He is a citizen or a resident of the United States, and he is not filing a joint return. I've just listed for you the dependency tests, and he passes every last one of them. So, but that's another subject later in the day. So we're going to move on. Past illustrations. Oh my gosh, we are not done with filing requirements. There's more for you to be confused by yet today. We're on to table number 1-3. Let's suppose you meet the conditions of either table 1 or table 1-2. We still have to be concerned with the conditions on table 1-3 because table 1-3 lists other reasons why you may be required to file a return even if your income is not high enough to meet the filing requirements. So if any of the conditions listed below applies to you, you must file a return even if your income is less than the amount shown on either of the first two tables we looked at today. And I've highlighted the ones in bold that are the most important. Social Security or Medicare tax on tips you did not report to your employer. If you have Social Security or Medicare tax due on tips you earned and did not report to your employer, you are required to file. You're also required to file if you owe the alternative minimum tax, or if you owe additional tax on a qualified plan, including an IRA, or additional tax on an Archer MSA or a health savings account, or you have a recapture of the first-time homebuyer credit or any other form of credit recapture, or if you have household employment taxes that you owe. Also, if you had net earnings from self-employment of at least $400, or you had wages of $108.28 or more from a church or qualified church-controlled organization that is exempt from employer Social Security and Medicare taxes. Now, we've been talking about the filing requirements for most people on the assumption that we're working and talking with an American resident or an American citizen. But there are people who are not citizens or residents of the United States who do have income from the United States and are required to file U.S. tax returns. And we call those people aliens. I come from Canada, and when we talk about people who are visiting Canada or temporarily in Canada, we call them temporary residents or we call them visitors. The concept of alien is unique to the United States, and it startled me from the minute I arrived here, but it's like aliens from outer space are arriving in this country. So anyway, for American tax law, you are an alien if you are not a resident green card holder or a citizen. So the filing requirements for aliens are different. If your status as an alien, or your status as an alien, resident, non-resident, or dual status determines whether and how much you must file as on an income tax return. So the rules used to determine your alien status are discussed in IRS Publication 519, U.S. Tax Guide for Aliens. And I'm not going to be teaching you all of the rules for aliens. That could be an entire class unto itself. And as a person who used to be an alien, I have some affinity for the topic, and I am going to write a class on it, possibly even this year. But let's first look at what a resident alien is. If you are a resident alien for the entire year, you must file a tax return following the same rules that apply to U.S. citizens. So what's a resident alien? Well, by definition, a resident alien is someone who has lived in the country long enough to be treated as a resident for tax purposes, or someone who holds a green card, even if they weren't residing physically in the United States. So if you're a physical green card holder, or you physically lived in the United States for enough days during a year, the IRS will deem you to be a resident. There's more to it than that. That's a very simplified term. And what the IRS really looks at is the number of days you were in the country. And when it exceeds 183 days, you're typically considered to be a resident. And if it's less than 183 days, you're not typically considered to be a resident. But that's a very simplified version, and don't ever make an assumption that that 183 days is the only test you need to apply. Non-resident alien. If you are a non-resident alien, the rules and tax forms that apply to you are different than those that apply to U.S. citizens and resident aliens. You should again refer to Publication 519 to find out if U.S. income tax laws apply to you and which forms you should file. We also have something called a dual status taxpayer. If you are a resident alien for part of the tax year and a non-resident alien for the rest of the year, you are a dual status taxpayer. Different rules apply for each part of the year. For more information on dual status taxpayers, again, take a read on publication 519. It's a gripper. Now we're going to move on to type of income. There's a question in the classroom, how long does a person have to live in the United States before they're required to file as a resident alien? It all depends. The answer to that question all depends on your treaty status and your visa status. If you're in the United States under an F1 worker visa and you're in the country for 183 days or more, typically you're going to be required to file unless there's some treaty provision that would exclude it or some other provisions like closer ties to your home country and so forth. It's too complicated. I could spend 3 hours talking about filing requirements for non-resident aliens. So we're just going to, I wanted you to be aware that aliens have different filing requirements. Where we live, where I live and work here in the city of Portland, we have a good base of non-resident alien filers who come into our company on a regular basis, mainly because we're next to the Intel plant. And Intel likes to bring in engineers, high-paid engineers from other countries. India and Pakistan and England are common ones. And so people from that company frequently come to our office, and so we see a lot of them. And you may live in a city where you also have large numbers of people who are in the country working on F1 visas, and you are regularly exposed to 1040-NR. On the other hand, you may live in a rural area where your specialty is farming, and you may never see a non-resident alien return in your whole life. So a lot of it is regional. Let's return again to the concept of the type of income. Your filing requirement is dependent on the amount of income you have. If you are dependent, your filing requirement is also tied to the type of income that you have. Only taxable income should be used to determine your filing requirement. Non-taxable income does not affect your filing requirement. So for dependents, we're concerned with, again, the difference between earned income and unearned income. Earned income is money or property you receive for services you perform. Examples include wages, commissions, tips, and farming or other business income. Earned income is taxable income that is used to determine your filing requirement. Unearned income includes income from investments such as interest, dividends, capital gains, rental property, and royalties. It also includes income from unemployment benefits, alimony, pensions, and other income that you receive that is not compensation for performing a service. Unearned taxable income is used to determine your filing requirement. If you are a dependent, unearned income can cause you to have a filing requirement at a lower level of income than is the case with earned income. So hopefully I've drilled it into you today that if you have a client who is a dependent, their filing requirement could be a very low number, as low as $950, depending on the type of income they have. Or it could be a pretty high number, $5,800 or more, depending on their age and their source of income if it's earned income. Yes? Okay. Well, there's a question in the classroom. What if I did get a job as a dependent and I have $3,600 of wage income and I have federal tax withheld? Do I have to file to get that withholding back? Well, the answer is yes. You should file to get the withholding back, but you are not required to file a tax return. So there's a difference between probably should file because there's a tax benefit if I do file, as opposed to am I breaking the law if I don't file? Because the law says if you meet the filing requirement, you're required to file. And this is the thing that actually gets a lot of people in trouble. They don't file because they don't think they should have to file, but then it turns out that they do have to file. So particularly when people leave the United States and move overseas, they're living, say, in Australia, and they've lived in Australia the last 5 years, and they've had a job there, their family's there, and they're a U.S. citizen. Are they required to file? Who thinks a person living and working in Australia with his family who is a U.S. citizen is required to file an American tax return when they haven't set foot in the United States in 5 years? The answer is yes, because it's totally based on income. And Aussie wages are pretty high right now. They're higher than American wages, so it wouldn't be hard to beat that filing requirement. Okay, non-taxable income. Non-taxable income is exempt from tax by law. Examples include child support, VA benefits, various military allowances such as housing allowances, workers' compensation benefits, gifts, life insurance proceeds, state and municipal bond interest, which is federally exempt only but may be taxed at the state level, and of course non-taxable income does not affect your filing requirements. Accounting methods and periods. You choose your accounting method when you file your first tax return. If you want to change your accounting method later on, you generally will require IRS approval to do so. The cash method of accounting means that you report all income in the year in which you actually or constructively receive it. Most taxpayers are cash basis taxpayers. In fact, so many people are cash basis taxpayers, most people couldn't comprehend of any other method of reporting income. But the other method of reporting income is the accrual method of accounting, which means you generally report income when you earn it rather than when you receive it. The accrual method of accounting is generally considered to be more accurate and is the required form of accounting for many kinds of businesses, including retail businesses and businesses that handle inventory. The problem with the accrual method of accounting is it is complicated. You have to have a good accounting system, and you have to keep track of the money that people owe you as well as the money that you owe to other people, not just what you brought in and what you spent. So this is not an accounting class, it's a tax class. But the accrual method of accounting is a more advanced accounting concept. Moving on to filing deadlines. April 15 is the deadline for timely filing of a return at the IRS, and should April 15 fall on a Saturday, Sunday, or legal holiday, the filing status is delayed until the next business day. You should note that Emancipation Day, a relatively newly created holiday in Washington, D.C., is celebrated or honored on April 16th. And in Washington, D.C., Emancipation Day is a legal holiday. So what's happening now is every time Emancipation Day falls on a weekend, and the same weekend we have April 15th, we're going to be pushing the filing deadline for taxes out beyond Emancipation Day. For example, in 2011, and I'm sure many of you remember this, April 15th fell on a Saturday, and Emancipation Day fell on Sunday, April 16th. Therefore, Emancipation Day was honored on April 17th, and the filing deadline moved to April 18th. And then in 2012, the filing season we just finished 2 weeks ago, Emancipation Day was April 16th, Sunday was April 15th, and so the final day of tax season moved to Tuesday, April 17th. Extensions. It is a common belief that you should file for an extension if you cannot afford to pay your tax by the due date of your return. But the reality is if that you owe money and can't afford to pay it, you should file your return on time and worry about how you will pay that money later on. So how do you request an extension of time to file? Well, you must pay your tax bill by April 15th or the next business day if April 15th is on a weekend or a legal holiday, regardless of whether or not you filed for an extension. Any tax not paid by the due date will be assessed a late payment penalty and will begin accruing interest at that point until it is paid. You file your extension using Form 4868, and you will notice that Form 4868 is actually a pretty simple form. It starts with how much tax liability do you have for 2011? And what were your total payments for 2011? Tax minus payments equals balance due. Send us the money with the extension. So, of course, if you fill out the extension form correctly and it shows that you owe whatever amount you think you're going to owe is the amount that you're supposed to send in. Now, there are different filing deadlines for people who are overseas. The filing deadline for most taxpayers is April 15th, but if April 15th falls on a weekend, the filing deadline moves to the next business day. However, special rules apply if you are outside of the United States or serving in a combat zone. For individuals outside of the United States, you are allowed an automatic 2-month extension until June 15 if you are a U.S. citizen or resident, and on April 15th, you are living outside of the United States and Puerto Rico, and your main place of business is also outside of the U.S. or Puerto Rico, or you are in the military or naval service on duty outside of the U.S. and Puerto Rico. So if you are a resident, if we go back to living in Australia, you've got your family in Australia, you're working in Australia, what's your filing deadline? it would be June 15. But wait, you still have to pay what you owe by April 15. So you have until June 15 to file if you're living and working outside of the United States, but you still have to pay what you owe on April 15. Now, to get an automatic extension because you were outside of the United States, you must attach a written statement to your return explaining which reason above, A or B, qualifies you for the exception. Now, there are also some special rules for people who are serving in a combat zone. The deadline for filing your tax return, paying any tax you owe, and filing a claim for a refund is automatically extended if you serve in a combat zone. You are considered to be serving in a combat zone if you are a member of the Armed Forces, Red Cross personnel, an accredited correspondent, or a civilian under the direction of the Armed Forces, and you were serving in the Persian Gulf area effective January 17, 1991, the Qualified Hazardous Duty Area of Yugoslavia, Serbia, Montenegro, Albania, and the Adriatic Sea, or the Ionian Sea north of the 39th parallel, or Afghanistan. How much is the extension period? The deadline for filing your return, paying any tax due, and filing a claim for a refund is extended for at least 180 days after the later of the last day you served in a combat zone or the last day you were last confined to a hospital for injury from service in the combat zone. Your extended period includes at least 180 days plus an additional amount of time equal to the amount of time you had left to file your return prior to April 15th, but before you entered the combat zone. So it could be up to 3.5 months plus the 180 days plus the length of time you were in the combat zone or in a hospital because of injuries sustained in the combat zone. So military people get a lot of extra time if they're serving in combat zones or were injured while serving in a combat zone. Penalties and interest for late filing. An extension of time to file, again, is not an extension of time to pay. You should estimate how much money you will owe when you file your return and mail the money with your extension. The IRS will charge you penalties and interest if you don't pay your money, the amount you owe, with the extension. Late filing and late payment penalties are assessed on unpaid taxes owed until they are paid. So what is filing late, or what is the penalty that is associated with filing late? Firstly, we have a failure to file penalty, which is assessed when your return is filed after the due date plus extensions. The usual penalty is 5% for each month or part of a month that a return is late, but not more than 25%. It is based on the tax not paid by the due date without regard to extensions. So if you file late, the IRS looks at how much you owe. If it happens to be that you're due a refund and you file late, there is no penalty for late filing because 5% of nothing is, well, nothing. 25% of nothing is nothing. But if you owe $5,000 and you file 1 month late, you're going to have a 5% or $250 penalty. And if you file 5 months late, your penalty will move up to 25%. Yes, and that would be a pretty nasty big penalty. Yeah, penalties in thousands of dollars are not at all uncommon. Return is more than 60 days late. If you file your return more than 60 days after the due date, including extensions, the minimum penalty is the smaller of $135 or 100% of the unpaid tax. Fraud. If your failure to file is due to fraud, the late payment penalty is 15% for each month or part of a month that return is late. The maximum failure to file penalty due to fraud is 75%. Late payment facts. A failure to pay penalty of 1/2 of 1% is assessed for each month or a part of a month after the due date that the tax is not paid. So there are two penalties I've just mentioned. One is the late filing penalty, and the other is the late payment penalty. There's two. So the late filing penalty is 5% per month. The failure to pay penalty is 0.5% per month. Yes. All right, so there's a question in the classroom, a bit of confusion over whether you're late when you have an extension. And the answer is there's two kinds of penalties we're talking about. One is late filing, and the other is late payment. The late filing penalty is associated with either is filing after April 15 without an extension or after October 15 if you did have an extension, right? So if you file late, either after April 15th when you didn't have an extension or after October 15th when you did have an extension, the penalty will be 5% per month. And if you file your return more than 60 days after the due date, the minimum penalty is the smaller of $135 or 100% of the unpaid tax. So the minimum penalty if you file 60 days late is going to be $135. Or if your tax is less than $135, it could be a smaller number than $135. But if your tax is higher than $135, the minimum tax penalty is $135. Now, aside from the late filing penalty, you may also have a late payment penalty. And the late payment penalty is owed even if you file on time. If you file on time but you can't afford to pay, guess what? There's a late payment penalty, but it is much less punitive than the late filing penalty. The late filing penalty and the late payment penalty are both associated with unpaid tax, but the late filing penalty is much more severe. So what the message in this is, if you can't afford to pay, file anyway. Because the penalty per month is 0.5% if you file but don't pay. The penalty if you don't file at all is 5% a month, 10 times as much. Yeah. Yeah. So you can also file Form 9465, and you're still going to have penalties or interest associated with installment payments, but they are far less than putting your head in the sand and hoping that the IRS doesn't notice you didn't file. Because they typically do eventually figure out that you didn't file, and then they're nasty about it. You are not required to pay this penalty, that is the 0.5% per month, if you filed an extension and paid at least 90% of your actual tax liability on or before the due date of your return, and you pay the balance when you file your return. Well, let's make this an easy illustration. I have a tax liability of $10,000 with my tax return. And on April 15th, I look to see that I'm going to actually, I think, maybe a couple thousand when I file. I've had $8,000 withheld. I think my tax liability will be $10,000. So I'm going to pay $1,000 with my extension. That'll bring my total payments up to $9,000 so that when I file in October, I will be 90% paid up. And that means I won't owe a penalty when I pay that final $1,000 back in October. Yes. The monthly rate of the failure to pay penalty is half the usual rate, 0.25% instead of 0.5%, if an installment agreement is in effect for that month. So let's just suppose April 15th comes. You can't afford to pay. You owe $5,000 and you can't afford to pay it. One of the options you have available is to request an installment agreement plan. The installment agreement plan does have a setup fee of $60 to $100 depending on if you do direct debit or not. I think it's actually $105 is the top end. And is it worth paying that amount of money to set up the installment agreement? Well, if you owe $5,000, probably, because the underpayment penalty that is normally 0.5% would drop to 0.25%, and you would be allowed to begin paying on installments until you're paid in full. The worst option of all is to stick the head in the sand and hope the IRS doesn't notice that you owed and didn't file, because that's probably not going to happen. If a notice of intent to levy is issued by the IRS, the late payment penalty will increase to 1% at the start of the first month, beginning at least 10 days after the day that the notice was issued. The penalty, however, cannot be more than 25% of your unpaid tax. You will not have to pay the penalty if you can show you had a good reason for not paying your tax on time. Combined penalties. If you file and pay late, your failure to file penalty of 5% or 15% is reduced by the failure to pay penalty. However, if you file your return more than 60 days after the due date of your return, including extensions, the minimum penalty is the smaller of $135 or 100% of the unpaid tax. Interest on tax owed. The IRS assesses interest on any balance owed until the tax is paid in full, and of course the interest is in addition to any penalties. Calculating your tax. Most people calculate income tax using tax rate tables. If your taxable income is greater than $100,000, you cannot use the tax rate tables and must use the tax computation worksheet. The tax shown on the tax tables or tax computation worksheet may be reduced or increased in certain situations, such as You have income from qualified dividends or capital gains. Investment income of $1,900 for certain children. Parents' election to report a child's interest in dividend income on their return, or the foreign earned income exclusion on your tax return. So if you're claiming any of those benefits or you have any types of these income on your tax return, the tax computation worksheet may not work for you, and then you would need to, the tax tables or the tax rate schedules would not work for you, and you may need to do a tax computation worksheet instead. And we'll get into those worksheets in other classes. They're not a subject of today's class. The subject of today's class is the basic for most people. You figure your income, you claim your personal exemption, you claim your standard deduction, you get your taxable income, you go to the tax table and figure your tax. So where do you find the tax rate tables? Well, you find those in Pub 17. I have a copy of it right here. And I'm going to actually share my screen with you for just a moment and take you to a version I found of Pub 17 on the internet. And once we're on the internet together, I'll show you a couple of things in Pub 17. But I did want to scroll to the end of this publication where we have the tax tables and the tax rate schedules. And of course, here's the tax tables. And for most people, your filing status is going to determine which column on this table you use, the single, the married filing joint, the married filing separate. If you have no unusual forms of income, or no, unusual wouldn't be the correct word, any special forms of income, such as qualified dividends, capital gains, you're excluding income due to the foreign earned income exclusion, you're including income of your children, these tables will usually work for you. But if your income goes above a certain point, and that's taxable income goes above a certain point of $100,000, you instead have to use these tax rate schedules instead of the tables. And it says if your taxable income is at least $100,000 but not more than $174, and your filing status is single, you're going to use this table to figure your income, or this schedule rather, to figure your income. And what this schedule does is it applies the tax rate schedules on the next page of Pub 17. And I'm inside Pub 17 roughly around page 276 when I'm looking at this tax rate schedule. And what it's saying is if you are single, these are the tax rates that apply to you based on the level of taxable income that you have. Now, something that confuses people is this concept of taxable income. And since this is a beginning or an introduction to our series, I'm going to take a minute to explain a concept that's probably really obvious to a lot of you, but I know there's a number of people out there who may still not fully grasp the concept of taxable income. So I'm just going to pull up a page 1040 here on IRS's website and show you where you go to determine taxable income. Oops, if I can type 1040. It's questionable sometimes. So here is 1040, and I'm looking at the front page of 1040, and of course the very first point of 1040 is, do I need to file the form at all? We started our class looking at that today, and in a little bit we're going to be talking about which one of these boxes do I check. I don't know, it's a mystery. We're going to figure out which one of those boxes I'm allowed to check, and then we're going to find out whether or not I'm allowed to claim myself as an exemption, or whether I'm a dependent of someone else and I can't put a check there. And then we're going to decide whether or not we're allowed to put children or other individuals on our return as dependents and put their names and their social security numbers in here. But all of this is kind of just a sidetrack. I need to get to the point of the topic and the reason I pulled up this form. And the reason I pulled up the form is I wanted to pull over to page 2 of the 1040. And of course, when I get over to page 2, I start with line 38. Line 38 is my adjusted gross income. And I actually started figuring my income on page 1, where I entered all of the different types of income I could have: wages, interest, dividends. I get my total income on line 22. Then I go over and I list any adjustments that I might have until I get to line 37, and I enter a figure that is called my adjusted gross income. Line 37 carries to line 38, and then I start entering deductions. I enter my standard deduction or my itemized deductions on line 40. I enter my exemption deductions. That's the dependency exemptions I'm allowed for myself and my dependents. And then I finally arrive at line 43, which is my taxable income. That's really exciting, folks, because taxable income is the point at which I return to Pub 17 and look at my tax. So when we're talking about taxable income, we are not talking about adjusted gross income. We're talking about adjusted gross income minus our deductions. And then we get a number on line 43. Whatever that number is, we move over to the tax rate schedules. Now, the tables are an easier way of looking up our tax, but the tax rate schedules are more eye-opening, because the question many filers ask is, what tax bracket am I in? Well, that depends on how many dependents you have, how much you make, and how many other deductions you have. You could have $200,000 of income and be married filing a joint return and be in a lower tax bracket than someone who is single with no dependents and earning $75,000. So tax bracket is dependent on your taxable income and your filing status. So let's look here at a single person. A single person who has income, taxable income of between $0 and $8,500 is in the 10% bracket. And a single person with taxable income between $8,500 and $34,500 is in the 15% bracket. And we keep going up until we have a single person whose income, taxable income, exceeds $379,150. And if that's you, baby, you fall in the 35% tax bracket. That's as high as it goes. And how does that vary by filing status? Well, married filing jointly, we can see we've got this same $379,150 number. That's still going to push you into a pretty high tax bracket. 35% is as high as it goes for a single person too. Married filing separately, you can see that the rate at which you hit the 35% bracket is half that of married. And married isn't terribly different than single. That's what we refer to as the marriage penalty. You'd think that you'd have twice the income under married that you do under single before you hit the maximum tax bracket, but that's not the case at all. I still remember George Bush giving a speech to the nation where he said he had eliminated the marriage penalty. He apparently didn't know what it was because he never eliminated it. So what he did do was make the standard deduction twice that. For married, he made the married standard deduction twice that of single, because up until 2001, when George Bush's Tax Relief Act was passed, the standard deduction for married filing joint was less than twice of single. And he did make the married filing joint standard deduction twice that of single. But the marriage penalty was definitely not eliminated. And then we have qualifying, or actually not, we have married filing separately, and then we have head of household. And we can see this, the tax brackets for head of household are more favorable. All right, other taxes. Now, it could be that you've just figured your tax using the tax computation worksheets, and you may discover that your tax cannot be accurately figured using those worksheets because you have a special situation that applies. And some of the reasons why those tax computation worksheets or tax tables will not give you the correct tax or the correct total tax are that you owe alternative minimum tax, or that you're subject to self-employment tax, or you have other additional taxes that are owed on things like qualified retirement plans and IRAs, or the household employment tax, or you have recaptures of an education credit, or the first-time homebuyer credit, or Social Security and Medicare tax on wages, or Social Security and Medicare tax on tips, or you have additional taxes on health savings accounts or medical savings accounts, or additional taxes on qualified tuition programs or Coverdell ESAs, or various other types of income that are subject to additional taxes. So the tax rate tables or the tax rate schedules will typically help you figure accurate income tax. And the only exception to the income tax calculation is going to be if you've got capital gain rates that apply. And if you have capital gain rates apply, you need to do a capital gain worksheet to figure out the tax that you will enter on Form 1040. Once you've finished figuring your tax and entering it on 1040, now you need to establish whether or not you're subject to any of these other taxes. And the thing about these additional taxes is that if you owe them, they trigger a filing requirement, even if your income is below the filing requirement for your filing status. And nextly, before we move on again, which is the form that I should use? Now, when I teach classes, I always teach from Form 1040. I like it. It's got lines for every form of income and every form of tax and every form of credit. But when it comes to professional tax preparation, our software may allow us to prepare other forms like 1040A or 1040EZ. And at least in my practice, it's relevant whether or not we're preparing an EZ or an A or a full Form 1040 because we price accordingly. And if we have a filer with a simple return that can fit on 1040 EZ, we actually charge less for that than if we have to fill out the long form. That's just how our company prices. Now, your company may price based on time or any other number of different things where the form that your computer grabs is not relevant. But just for tax preparation purposes, tax knowledge purposes, I think it's relevant that you should be at least able to determine whether a client qualifies for a particular form. And of course, when we take a look at Form 1040, this is the form that can be used by virtually all filers, but there are some exceptions. If you have self-employment income from Puerto Rico, you will need to file Form 1040 PR. If you are a non-resident alien of the United States, you will need to file either Form 1040 NR or 1040 NR EZ. And also, if you have income from America Samoa, the Commonwealth of the Northern Mariana Islands, Guam, Puerto Rico, or the U.S. Virgin Islands, you may have to file a tax return with the state tax department of that particular U.S. possession. Or you may have to file 2 annual returns, one with the possessions tax department and the other with the Internal Revenue Service. By comparison, we have 1040A. Form 1040A is simpler to complete than 1040. It was designed so that people who are filling out a form by hand can have an easier time of it. However, this form has restrictions in the type of income, credits, and deductions that can be reported. For example, on Form 1040A, you can report income from wages, pensions, interest, dividends, and unemployment, but you cannot report income from stock sales, self-employment, or rental properties, or even alimony. Also, since 1040A cannot be used by all taxpayers, you should probably talk with them for a few minutes to establish whether or not they're going to need the long form. 1040 EZ is, of course, the simplest form to complete. It's intended essentially to be a wage form only. You can throw a little bit of interest income up on there, up to $1,500, and you can also put unemployment on it, and you can even put Alaska Permanent Dividend Fund income on 1040 EZ. But you're only allowed 2 filing statuses, single or married filing joint, and if you don't qualify for either of those filing statuses, 1040 EZ is not an option. And Form 1040 PR, again, that's the form used by people who have self-employment in Puerto Rico, including farming income. 1040 PR is actually written in Spanish, and if you're an English-speaking person like me and you're trying to find a Puerto Rican tax form and 1040 PR keeps coming up in Spanish, the answer or the solution is to do a search engine for 1040 SS. That is the Spanish language equivalent. Yes, I've even done a 1040 PR here in Portland, Oregon. I've had one come in the door a few years ago. 1040 NR. There were a few questions in the classroom, at least, on 1040 NR, and I'm going to go a little bit more into the details of the special things you need to know about 1040 NR here today. Form 1040 NR is used by people who are not residents or citizens of the United States. You must file Form 1040 NR if you meet the residency requirements for filing a U.S. tax return and had taxable income. The facts you should know about Form 1040 NR include: you may be required to file Form 1040 NR if you are not a U.S. citizen and you resided in the United States for less than 183 days during the year. If you are required to file Form 1040 NR, you are not allowed to claim a standard deduction and must itemize deductions. However, there is an exception to this rule if you are a student or a business apprentice from India. If you are required to file Form 1040 NR, you cannot file a joint return with your spouse unless you were a resident of India. The United States has signed tax treaties with many different countries. If you are a resident of a foreign country living or working in the United States, you may be affected by a tax treaty between the United States and your home country. Tax treaties between the United States and other countries are outlined in IRS Publication 901, U.S. Tax Treaties. It's a whole publication about yay thick, page after page after page of tax treaties by country. So if you want to know what the tax treaty is between the United States and Canada, that's a place you can go. If you want to know what the tax treaty is between the United States and New Zealand, you can find it there. If you want to know what the tax treaty is between the United States and, I don't know, the United Kingdom or Sweden or anywhere else you can think of, that's the place you go. Number 5, even if you were outside, or pardon me, even if you were inside of the United States for more than 183 days, You may still be required to file Form 1040-NR if you are a student, generally holding an F1 or a J1 visa, a teacher, generally holding a J1 visa, a researcher, or a temporary worker, generally holding an H1 visa, if you are specifically affected by a tax treaty between the United States and your home country. Now, most people who enter the United States under F1 visas, once they pass that 183-day mark, they are required to file U.S. tax returns. But it is still important to consider the tax treaty, because if the tax treaty specifies that they're not subject to treatment as U.S. residents, then you would still file 1040-NR. And then we have 1040-NR-EZ, which is a simpler form than 1040-NR, but I personally never fill that one out. Now we have something called a dual status taxpayer. I mentioned it a little bit earlier. A dual status taxpayer is an individual who was a non-resident of the United States for part of the year and a resident of the United States for the other part of the year. As a dual status resident, you will prepare and file Form 1040-NR for the part of the year you were a non-resident, and you will prepare Form 1040 for the part of the year that you were a resident of the United States. Well, that sounds like a lot of work. I got to do 1040-NR, plus I have to do 1040? That could get confusing. Do you have to do that? Well, you don't have to, but it may be beneficial. So let's read on. You can make a first-year election to be treated as a resident of the United States for the entire year. In certain situations, it may be beneficial for you to make a first-year election to be treated as a U.S. resident for the entire year. Whether you benefit under this election will depend on the specifics of your particular tax situation. For example, if you are married and you brought your spouse and your children with you, you may wish to file as a full-year resident because you would be allowed to use the married filing joint filing status and to claim certain tax credits that are not available to 1040-NR filers. On the other hand, if you are single and you had high income outside of the United States prior to arriving in the United States, you may not benefit from making a first-year election, which would require you to pay U.S. tax on all of your worldwide income for the year. So there's quite a bit more to that. You could see I could teach a whole class on it, and I do plan to at some point in the future, but not during this series. Taxpayer Identification Number, or TIN. Most people who file their tax return are going to file using their Social Security number, but there are some people who are not eligible for a Social Security number, and those include people who are in the country illegally, and it also includes some people who are here in the country legally but are still not eligible for a number. Now, most of the time when individuals are admitted to the United States under J1 or H1 visas, they're going to be eligible for a Social Security number. The visa type typically offers some allowance for working and earning money, and as soon as you're legally entitled to work in the United States, you're typically going to be entitled to a Social Security number, and you march down to the office with all of your particular visa status documents and apply for a number, and they'll give it to you. But what if you brought your family with you? You're in the United States under an H1 visa, you're here to work for 3 years over at the Intel plant, and you brought your wife and kids with you. Well, they're going to be in the country under a different visa status, and they're not going to be entitled to work. And as such, they're not going to be entitled to Social Security numbers, so what do? Well, you need to file an application for an ITIN, an Individual Tax Identification Number, and I have the form that you use for that right in front of you. It's a Form W-7. Typically, the IRS wants to see Form W-7 attached to the tax return on which the number is needed. So the very first year you file a tax return, when you don't have a number that you need to have, and that number is going to be an ITIN, you attach Form W-7 to your return for each person for whom you wish to have an ITIN. So let's just suppose we have Jack, who's arrived in the United States from England under an H-1 visa, and he's brought his wife Jane and his 2 children with him. Jane and his children are not entitled to have Social Security numbers. Jack is. Jack puts his Social Security number on the line, on the Social Security number line of the taxpayer on his tax return. He's going to attach 3 W-7s to his return. 1 W-7 for his wife Jane and 1 W-7 for each of his 2 children. So he's going to have a total of 3 applications. He'll attach notarized copies of identification to the W-7, and he will mail the entire tax return off to IRS requesting tax identification numbers, or ITINs, for his wife and his 2 dependents. The IRS will then issue those numbers to him and allow those deductions. In theory, if the IRS does not lose the application or one or more of the applications. And my experience is when you mail in multiple applications to the IRS, they are bound to lose at least one. So do anticipate problems with the IRS processing W-7 applications because they lose them. Another reason why you might need to apply for a tax identification number is if you are adopting a child. In certain situations, you're not able to get that child's Social Security number or have one issued to that child until the adoption is complete. And during the adoption process, you might need to apply for an ATIN, or Adoption Taxpayer Identification Number. Filing methods. There are different methods for filing a tax return, and of course the old-fashioned way is a paper return in the mail, but today most people file electronically. If you are a tax professional being paid to prepare 11 or more returns during a tax season, or actually during an entire calendar year, e-file is now required. It is no longer optional. And that 11 return rule applies aggregately to all preparers working within a firm. So if your firm prepares 11 or more returns in a year, e-file is now mandatory. If you are filing electronically, you still have to collect your client's signature, and you do that on Form 8879. There's a place for the taxpayer to sign, a place for the spouse to sign, and a place for you as the electronic return originator and paid preparer to sign. In certain situations, you may need to have paper attachments go with an electronically filed return. And when you have a paper attachment that needs to be filed with an electronic return, you will mail Form 8453 to the IRS along with that paper attachment. And I'm just going to zoom in a little bit here so we can see some of the reasons why an 8453 might need to be attached. One of them is you have a Form 1098-C, which is an acknowledgement of a donation of a car, a motor vehicle, boat, or airplane. So if you donated a car and you were given a 1098-C, the IRS wants that 1098-C to get mailed into them. You'd have to attach the 1098-C to Form 8453 and mail it to the IRS separately, and then you still e-file the tax return. Also, if you have a change in accounting method that you applied for on your tax return, you have to attach Form 3115 and mail that in with 8453. Another one here is Form 8332, release or revocation of release to claim of an exemption for a child. So if you are claiming a child under Form 8332, the IRS wants you to mail that in with Form 8453. Can you e-file a tax return with Form W-7 attached? That's a question coming from an online student, Jason. The answer is no. No e-file for Form W-7. You cannot electronically file when a Social Security number is incomplete or missing. And of course, a missing tax identification number would be a reason for the return to not go through electronically. And the last filing requirement we're going to talk about before we move on to filing status is decedents. The filing requirements for deceased taxpayers are the same as for living taxpayers. The fact that you died does not change anything in terms of filing requirements. However, what is important is that when you look at the income of a person who has died, you look only at income they earned while they were alive. If a person died on the 2nd of January, odds are they're not going to be required to file because they probably didn't earn enough money to be required to file in the 2 days they were alive for the year. But if a person died later on in the year, you're going to have to look at all of the income that they earned during the part of the year that they were alive and see if it meets the filing requirement for their age and filing status. And if it does, then they are required to file. The dead person is required to file. And it's the executor or administrator of the estate who is responsible for ensuring that that deceased person's final tax return is filed. And of course, when a person has died, you do write the date of death at the top of the return. And you include on that return all income earned up until the date they died. And in the occupation section, you would write the word deceased. Now, what about all the income that's earned after the person dies? Well, income earned from assets or property of a decedent after that decedent's date of death is income of the estate. And if the income of the estate is high enough, the estate will need to file a tax return as well. So it's not at all uncommon that in the year of death, you will prepare a tax return for the decedent on Form 1040, and you will prepare a tax return for the estate using Form 1041. 1041 is, of course, a whole other subject we're not getting into today. It's something that you should have your mind on. Now, A personal representative may revoke a joint return election made by the surviving spouse. Typically, an election to file a joint return can be changed only up until the due date of the return, not including extensions. So if on February 15th you file a joint tax return, and on April 10th you change your mind and you decide to file separately, you can amend and do that. But once April 15th passes, you can no longer amend from married filing joint to married filing separate. The exception is if you are talking about a joint return that was filed for a decedent. Because if a joint return was filed for a decedent, the administrator of the estate has up until 1 year after the date of death to change that or revoke that election, or actually 1 year of the due date of the original return, including any extensions. Also, generally a person who is filing a return for a decedent and claiming a refund must file Form 1310 with the return to claim that refund. However, if the person claiming the refund is the surviving spouse or a court-appointed or certified personal representative filing an original return, the Form 1310 is not needed. Instead, you would attach a copy of the court certificate showing that he or she has been appointed. A surviving spouse who is filing a final joint return should write filing a surviving spouse in the signature section of the return and does not need to attach Form 1310. Typically, a surviving spouse filing a joint return is going to be able to file electronically. If you need to attach Form 1310, or if you are anyone other than the surviving spouse, you may not be able to file electronically. It depends on a variety of factors. You don't attach a copy of the death certificate to the return. If you are the surviving spouse, you simply sign for your deceased spouse and write filing a surviving spouse. If you are a court-appointed representative, you need to attach that court appointment document. And if you are, say, a child who has not been appointed by the state, you're just taking care of the estate as the child, you're the administrator, but you weren't court-appointed, then you would need to attach Form 1310. Filing status. Firstly, marital status. In general, your filing status depends on whether you are considered unmarried or married. For federal tax purpose, a marriage means only a legal union between a man and a woman as husband and wife. State law governs whether you are considered married or unmarried. This is kind of a contradiction because there's a number of states out there that have allowed same-sex marriages. So IRS is saying state law determines whether you're considered married or unmarried, but only for man and woman, not same-sex marriage. So the IRS does not recognize a same-sex marriage, even though at the state level that may be recognized. And there's a variety of states that do recognize same-sex marriage and or domestic partnerships. There are 3 important things to remember about your filing status. Your filing status on the last day of the year, generally December 31, will determine your filing status for the entire year. State law governs whether you are considered married or unmarried, and your filing status will be used to determine your filing requirement, which was way up on page 1 of today's session. Your filing requirement is based on your filing status. It also determines your standard deduction, your allowable credits and deductions, and your correct tax. There are, of course, 5 filing statuses. They include single, married filing joint, married filing separate, head of household, and qualifying widow or widower with dependent child. Some taxpayers qualify for more than one of these statuses, and if you qualify for more than one status, you are allowed to choose the one that is the most advantageous for you. Now, sometimes in the case of married filing separate nearly always results in higher tax than married filing joint, but not always. Sometimes a married filing separate return will give you lower tax than joint. Even if it gives you higher tax, you may still wish to file separately, and you can file separately if you don't want to file a joint return. So let's look at the rules for single, the first and simplest of all statuses. To file single as your filing status, you must be unmarried, divorced, or legally separated from your spouse under a decree of separate maintenance. If your spouse died during the year, you are considered to be married for the entire year. You are not single. If you are divorced on the last day of the year, however, you are considered single for the entire year, and you may not file as married. If you are married on the last day of the year, you are considered married for the entire year, and you are not eligible to file as single. Married filing joint. You can choose married filing jointly as your filing status if you are married and both you and your spouse agree to file a joint return. On a married filing joint return, you report your combined income and you deduct your combined allowable expenses. Joint returns are usually the most advantageous filing status for a married couple because the tax rates for joint are usually lower than for separate. And if you file a joint return, you and your spouse are jointly responsible for tax and any interest or penalty due on your joint return. One spouse may be held responsible for all of the tax due, even if the other spouse earned all of the income. So here's the deal with married filing joint and why sometimes I encourage people to not use it, even though separate status will increase their tax. So you have a couple who is not getting along, and one of them is maybe not particularly good at keeping up on his taxes, and the other one does not want to be held responsible for his debts. So I have a client who is my client. She comes to me because she's getting a divorce, and she wants to know if she has to file jointly with her husband. And the answer is no, you don't have to file jointly. Now, you may pay more tax if you don't file jointly, but if all of the tax you're not paying is his tax, that's his problem. So if he files separately and his tax bill goes up, that's his problem. If you file a joint return and you owe tax because of his income, now it's your problem. So there can be a very good reason for not filing jointly with your partner if you do not have a good marriage. Now, even if you do have a good marriage, maybe you just prefer to keep your finances separate and you don't want to put them together under any circumstances. And if that's your preference, then as the tax professional, we should do what our client wants. Of course, the key thing to remember about married filing separate is if your spouse itemizes, you are required to itemize. Now, to be considered valid, a joint return must generally be signed by both the taxpayer and the spouse. There are some exceptions to that. If you file married filing joint, you generally cannot choose to file married filing separate after the due date of the return. Married filing separate. Married filing separate is generally the least favorable of all filing statuses. If you don't have a good reason for filing separately, it's best to avoid it. Married filing separate taxpayers are subjected to many restrictions that often cause them to pay more tax than if filing jointly. Married filing separate taxpayers also do not qualify to claim the student loan interest deduction or the child and dependent care credit or any education credits or the tuition and fees deduction or the earned income credit or the adoption exclusion or credit. Also, more of your Social Security or railroad benefits may become taxable. Generally, you will not be allowed to deduct passive rental real estate losses, and your capital loss carryover is limited to only $1,500 per year. So I often have tax preparers who call me and they go, April, no matter what I do, I cannot get my computer software to give my client this education credit. What am I doing wrong? And the first thing I say is, what's the filing status? Or what's the income? Because, of course, the education credits have a phase-out based on income, but they also have not allowed based on filing status. And the child and dependent care credit is one of the more common ones that just, poof, disappears on people when their filing status goes to married filing separate. And my preparers are putting all this information in their computers trying to generate this child and dependent care credit, and it's not popping up, and filing status, married filing separate is the reason. Head of household. Okay, if there's anything in the world of filing status that is confusing, it is this filing status. And if you go take a test of any kind at the IRS or at the state level, and they start asking you questions about head of household, you need to know your stuff or you're going to flunk those questions. So we're going to spend the most part of today's session on filing status talking about this one category because it's the most tricky of them all. And people very often confuse head of household with other things, other tests that sound similar, such as the test for claiming the earned income credit or the test for claiming a dependent. Head of household is a category or a definition unto itself. So let's see how much of it we can absorb in the next few minutes today. Head of household is, of course, a status that has some advantageous things associated with it, but we're only looking at whether or not you qualify under IRS definitions for head of household. And you may be able to file as head of household if you meet the following requirements. Number one, you must be unmarried or considered unmarried. So in general, you can't be married if you want to be head of household. But we're going to look at something where you might possibly be married, but considered to be unmarried. All right? Number 2, you paid more than half the cost of keeping up a household for the year. A qualifying person must live with you in the home for more than half of the year. If the qualifying person is your parent, they do not have to live with you. And the qualifying person must be your dependent unless that individual is your qualifying child. If you qualify as head of household, your tax rate is usually lower than the rates for single. So let's go through these again. You must be unmarried or considered unmarried. You must pay more than half the cost of keeping up a home for the year. A qualifying person must live with you in the home for more than half the year. If the qualifying person is your parent, however, they do not have to live with you. And the qualifying person must be your dependent unless that individual is your qualifying child. So there's 2 things here. To be head of household, you have to keep up a household in which the qualifying person lives unless that person is your parent. Your parent does not have to live with you to qualify you for head of household. You must also be able to claim that person's dependency exemption unless that person is your qualifying child. So if the qualifying person is your qualifying child, then you don't have to claim their dependency exemption. But that child has to live with you. Your parent doesn't have to live with you, but you have to be able to claim their exemption. So it's possible to be head of household and have that qualifying person be your dependent parent who lives in his or her own home, or a nursing home, yes. Now, what does it mean to be considered unmarried? Because the first test said you have to be unmarried. Or what if you're married? Do you meet the test for being considered unmarried? And it's these tests for being considered unmarried that confuse people so much. You are considered unmarried on the last day of the year if you are not married, or you are legally separated under divorce decree or separate maintenance decree. Even if you are married, you are considered to be unmarried if you meet all of the following tests. Firstly, you file a separate tax return. You pay more than half the cost of keeping up your home for the year. Your spouse did not live with you in your home during the last 6 months of the tax year. Temporary absences such as military assignment, school, or nursing home are considered to be time spent at home. Your home was the main home of your qualifying child, stepchild, adopted child, or eligible foster child for more than half the year. You must be able to claim an exemption for your child. However, you can still meet this test if you cannot claim the exemption only because the non-custodial parent is allowed to claim the exemption for the child. Now here's an illustration of these tests. Sylvia is married, and during the year she paid more than half the cost of maintaining a home for herself and her 10-year-old son. Sylvia's husband did not live with her during the last 6 months of the year. Sylvia will not be filing a joint return. Sylvia cannot claim her son as a dependent because she signed Form 8332 releasing her son's dependency to her husband. Sylvia meets all 5 of the tests for being considered unmarried and can file as head of household. So let's take Sylvia and let's look at these tests. Is she going to file a joint return with her husband? No, she's not. She will file separately. Did she pay more than half the cost of keeping up a home? Yes, she did. Her spouse did not live with her at any time during the last 6 months of the year, so she passed that test. And her home was the main home of her qualifying child being her 10-year-old son, who lived with her for more than half of the year. And finally, she's not claiming her son's dependency, but the only reason she's not claiming it is because she gave it to her husband. So those are the rules for head of household. And, you know, the best way to start understanding or grasping the head of household concept is to look at the quiz questions and the homework questions we have at the end of today's session. We'll show you those because you can kind of work through those if you like to see how much of that you were grasping. Because it's when you start actually looking at family situations that the definitions start to ring home and have some meaning. The final filing status we're going to look at is qualifying widow or widower with dependent child. This filing status entitles you to use the joint tax return tax rates and the highest standard deduction amount if you do not itemize your deductions. You are eligible to file your 2011 return as a qualifying widow or widower with a dependent child if you meet all of the following tests. You are entitled to file a joint return with your spouse for the year your spouse died, but it does not matter whether you actually did file a joint return. Number 2, you did not remarry before the end of 2011. you have a qualifying child, stepchild, or adopted child for whom you can claim an exemption. This does not include a foster child. This child lived with you in your household the entire year except for temporary absences. So for head of household, you have to keep up a house for your child for more than half the year, or for your qualifying person for more than half the year. But for qualifying widow, you have to maintain a home for your qualifying child for the entire year. Head of household requires a qualifying person. A qualifying person can be a qualifying relative or a qualifying child. It can be a qualifying relative for head of household, provided the relative is related to you. So you cannot be head of household by maintaining a household for your boyfriend or girlfriend because they are not related to you. But you can be a head of household by maintaining a household for a qualifying relative, such as your parent. However, when you move over to qualifying widow, you have to have a qualifying child who lived with you for the entire year as a member of your household except for temporary absences. So the concept of qualifying child and qualifying relative, that falls under dependency, which for now, just looking at qualifying widow or widower with dependent child, you have to keep up a home in which your qualifying child lived with you for the entire year. A qualifying child is your child, stepchild, or adopted child for whom you can claim an exemption, but does not include your foster child. You must have paid more than half the cost of keeping up a home that is the main home for you and the child for the entire year, except for temporary absences. And finally, your spouse must have died in 2009 or 2010. So these tables here are kind of sort of rearranging the same information two different ways to help you make sense of it. They both have the same header, filing status options available for different filing situations. We can see we have a list of filing status options: single, married filing joint, married filing separate, head of household, or qualifying widow. And then we look at the filing statuses or the marital situations that could apply. So if you want to file a single, you have to be single or you have to be divorced. You can also file single if you are widowed with a dependent child. It wouldn't be the best filing status choice, but you could choose it. Married filing a joint return, you have to be married, or if you are a widow, it is the year of death. Married filing separate, the only time you ever use that status is if you are, in fact, married. Head of household, single. You can use the head of household status for if you are single, and of course you have a qualifying person. If you are married and you meet the conditions for being considered unmarried because you have a qualifying child and meet other tests. You can also file as head of household if you are divorced and have a qualifying person, and if you are widowed and have a qualifying person. Qualifying widow or widower with dependent child, the only time you are allowed to use that status is if you are a widow or a widower, and it is for the first 2 years after the year of death, and you have to have a qualifying child. So now we take the same information and arrange it just a little bit differently. It's communicating the same message. You can use this filing status if you are the line underneath. So you can use the filing status single if you are single. You can use the filing status married filing joint if you are married living together or married living apart. You can use the filing status married filing separate if you are married living together or married living apart. You can use the filing status head of household if you are single and have a qualifying person, if you are divorced and have a qualifying person, if you are widowed and have a qualifying person, or if you are married, living apart, or separate, and you meet the test for being considered unmarried, and you have a qualifying child. And finally, qualifying widow or widower with dependent child, you must be widowed and you must have a qualifying child. Now, when I'm talking, I make a deliberate point of separating three concepts. One is a qualifying person, the other is a qualifying relative, and the third is a qualifying child. And you may as well start to cement in your mind what a qualifying person is, what a qualifying child is, and what a qualifying relative is, because they are key to establishing the correct filing status, and they are also key to establishing whether or not you're allowed to claim a dependency exemption for a particular person.
And the third password for session number 1 is VANNER, V-A-N-N-E-R. It is now time to complete classwork assignment number 1. Please flip to page 28 at the back of your session 1 manual to review the classwork 1 assignment with me. Classwork assignment number 1 is a series of 4 questions, and your job is to determine whether or not the dependents described in each question are required to file a return. And then you finish the other 3 on your own. Number 1, George, age 17, is a dependent. He had the following sources of income for the year: wages of $3,625, interest of $79, and dividend income of $13. Is George required to file a return? Well, to answer this question, we have to think about his standard deduction. His standard deduction is a combination of his earned income plus the additional deduction for his unearned income up until the point his earned income hits $5,500. So his earned income is $3,625. Because that's less than $5,500, his standard deduction will include that full amount. The next step is to add on $300. And if he does that, he ends up with a standard deduction of $3,925. That amount is greater than his income. He is therefore not required to file a return. So at this point, I would like you to push pause on video playback. Complete questions 2, 3, and 4. And when you are ready, please resume video playback for a review of the Classwork 1 answer key. I have up in front of you now the Classwork 1 answer key. You can access and print a copy of this answer key inside the materials page for session 1 of this course. Let's take a look at question number 2 from Classwork 1. Kathy, age 21, is a full-time student. She had the following income for the year: interest income of $635 and dividend income of $320. Is she required to file a return? Well, let's think. She's not age 65 or older, she's not blind, and she had no earned income. She has none of the items that will allow her to increase her standard deduction above the minimum amount of $950. So does her income exceed $950? Well, $635 plus $320 is $955. $955 is greater than her allowable standard deduction of $950, so she is required to file a return. Let's move over next to question number 3. Carl, age 67, is a dependent of his daughter Martha. Carl had the following income for the year: Social Security of $6,000, non-taxable, pension income of $3,000, and interest of $173. Is Carl required to file a return? Well, first off, let's look at this Social Security, because this is really in here as a red herring. You're probably wondering, what's up with this non-taxable Social Security? Well, it happens to be that non-taxable income does not affect your filing requirements. So we throw that number out and look at what's left. Well, what's left? $3,173 of unearned income. And is there anything that would cause Carl to have a standard deduction for himself that exceeds $950? The answer is yes. He is age 65 or older. He's 67. So his standard deduction is actually going to be increased by $1,450. So his standard deduction is $950 plus $1,450, or $2,400. Is $2,400 more than his income? Well, no, it's not. His income is $3,173. That is more than his standard deduction. Therefore, Carl is required to file a tax return. And the final question of the day, Nancy, number 4, age 18, is a dependent of her parents. She had the following income for the year: wages of $4,400 and a prize of $725. The prize is considered to be unearned income, and therefore we're going to calculate her standard deduction based on taking her wages and adding $300. Her wages are less than $5,500. They are $4,400. So her standard deduction will be $4,400 plus $300. Is her income more than that? Yes, it is. Her income is $5,125. Her standard deduction is only $4,700. She is therefore required to file a tax return. It is now time to complete classwork assignment number 2. So please turn to page 29 in your student manual, and we will review this assignment together. The wording tells you to use Table 1.1 in Pub 17, page 4. So I'm just going to flip to page 4 of Pub 17 right here, and find the table they're referring to, and we can see it right there. And here is Table 1.1 on page 4 of Pub 17. So let's take a look at the question. None of these taxpayers can be claimed as a dependent by someone else. Are they required to file a return? We're going to begin with question 1. The filing status is married filing joint. The taxpayer age is 55. The spouse age is 65, and the gross income is $19,900. So we're going to go over to the filing requirements for most taxpayers, find a married filing joint, and then with one person or one spouse being age 65 or older, the filing requirement is $20,150. That amount is greater than $19,900, so this couple, number 1, is not required to file a tax return. Now you will note that we have federal income tax withheld of $100. This couple would be wise to file a return because they would be able to receive a refund of that $100, but the fact that $100 was withheld does not mean that they are required to file, merely that they should file. So at this point, please push pause on video playback. Complete classwork assignment number 2, questions 2 through 10. When you are finished, please resume video playback for a review of the classwork 2 answer key. And I have up in front of you now the classwork 2 answer key. If you would like to have a printed copy of these answer keys, please go to the materials page for session 1 and print the classwork answer keys. In question number 2, we have a taxpayer who is single and age 69. Is this taxpayer required to file a return if their income is $9,700? The answer key says no. Let's go to Pub 17 and see why. Here we have a single filer, age 65 or older. The filing requirement is $10,950. So question number 2 is not required to file a return. Question number 3 is single, age 18. Is this person required to file a tax return with $9,400 of income? We go to the single column and we show $9,500. So the answer is no, not required to file. But we do have $500 of withholding, which means this single person would be wise to file if they would like to see that $500 be refunded to them, but they're not required to file. Number 4, head of household filer, age 18 with $11,250 of income. So we go over to head of household under the age of 65. The filing requirement is $12,200. The income of $11,250 is less than that. So number 4 is not required to file. Number 5, married filing joint, age 25 with a spouse age 30 and joint income of $19,300. We go over to the married filing jointly column. We look at where both spouses are under age 65. The income filing requirement is $19,000. Their income is more than $19,000, so they are required to file a tax return. Number 6, qualifying widow, age 67. Gross income is $15,000 with $50 of tax withheld. Is $15,000 enough to require a age 67 qualifying widow to file? So we go down to qualifying widow, find age 65. The filing requirement is $16,450. This person is not required to file, but if they want to get that $50 refunded or any earned income credit they might be entitled to, they would need to file, but they're not required to. Number 7, qualifying widow, age 60 with $15,150 of income. So we go down to the table, look at under age 65. We see $15,300 is the filing requirement. The income at $15,150 is less than that. So number 7 is not required to file. Next up, we have married filing separate, age 49 with $4,900 of income. Is this person required to file? Well, the answer is if you are married filing separate and any age, the filing requirement is $3,700. $4,900 is more than that, so number 8 is required to file. Number 9, married filing joint, age 52. Spouse's age is 49 and the income is $14,700. We go over to married filing joint. Both spouses are under age 65. The requirement is $19,000. Their income is less than that, so they are not required to file. With $100 of withholding, they would want to file to receive that refund, but they're not required. And then under number 10, the filing status is single. The age is 62. The income is $7,950. $7,950 is less than $9,500, so question number 10 is not required to file. And this is the conclusion of Session 1 of the Basic Tax course. The Session 1 homework assignment is located beginning on page 30 of your student manual. I'm going to review question 1 with you. I'm also going to review question 5 with you, and then your job will be to finish the rest of the assignment on your own. Question 1 says, for each of the following individuals, use the tax tables in Pub 17 on pages 260 through 271 to calculate the correct tax. And the first problem is Mr. J's filing status is married filing separately. His federal taxable income is $29,580. His federal tax is blank. So let's go in Pub 17 to pages 260 forward. So I've opened up Pub 17 on the main part of your computer screen here so we can take a better look at it. The problem is now smaller on the right-hand side of the screen, and we're looking at Mr. J's filing status is married filing separately. We need to go to the married filing separate column and then find his income amount. So I'm just going to scroll down Pub 17 until I get to $29,580. $550 to $29,600. So we move across to this column and we see $3,586 is the answer. And in this space right here, you will type $3,586. Questions 5 through 8 require you to use the computation worksheets for line 44 shown on page 273 of Pub 17. So let's do number 5 together so you understand how it's supposed to work. Mr. and Mrs. B are married filing jointly. Their federal taxable income is $151,089. Their federal tax is blank. Well, because their taxable income is over $100,000, they can't use the tax rate tables. They have to use the tax computation worksheet to figure the amount of tax that they owe. So we use the tables and find the correct table for their filing status, and we're going to use table section B because that is the table for married filing jointly. So the starting point is to enter $151,089 in column A. Next we move over to column C and we multiply $151,089 by 28%. So I get out my handy dandy calculator, I go 151,089 multiplied by 0.28 equals $42,304.92. So I'm going to enter 42,304.92 in the space provided on the table. The next step is to subtract out $11,930.50. Now, why do we do that? Well, the reason we do that is $11,930.50 is the income tax owed on the first $139,350 of income. So we're not going to add that back in again and get taxed it twice. So we're going to take out the $11,930, and we get $30,374.42. So that is the correct tax to enter on line 44 of the Form 1040. While I'm on this subject, let's take a little bit of a thinker on what line 44 of the 1040 even means, because taxable income is a concept you really need to understand. So I'm going to open up Form 1040 and show it to you real quick. So here is Form 1040. Form 1040, as you know, is a 2-page form. You use page 1 of the form to provide identification information about the filer and dependent's filing status and to enter income and adjustment amounts. When you get to the bottom of page 1, you have a total. This total is referred to as your adjusted gross income. Your adjusted gross income is entered on line 37 at the bottom of page 1. You then go over to page 2, and on line 38, you enter your adjusted gross income as it is shown on page 1, line 37. The next step is to subtract out your standard deduction. And we discussed standard deductions today. They are spelled out right here for you. If you are single, you would enter $5,800. If you are married filing joint, $11,600. And if you are head of household, $8,500. This is, of course, unless you are itemizing your deductions. And if you are itemizing your deductions, you would enter your itemized deductions on line 40 instead of your standard deduction. Let's do a quick illustration here. Let's suppose my adjusted gross income on line 38 is $50,000. I then go over to line 40 as a single filer and enter my standard deduction of $5,800. I'm under age 65. Next, I subtract 58 from 50 and I get $44,200. I'm allowed to claim a single exemption deduction for myself of $3,700. You can see right here it's telling me I can claim that, one for myself, and I enter it on line 42. Then on line 43, I have my total, $40,500. This total is my taxable income. This is the number I will use to look up my tax in Pub 17. So $40,500 is my taxable income. Let's go over to Pub 17 and take a look at the tax tables to calculate the amount of tax I owe on $40,500 of taxable income. I'm going to scroll through the tables until I get to my income level. And here is my income, $40,500. I go over to the single column and I see that my income tax to enter on line 44 is $6,256. So now that I've reviewed your homework assignment with you, it is time to end this lecture. Complete your homework assignment, questions 1 through 8. When you've finished completing your homework assignment, go to the assignments page inside session 1 and complete the homework test. You will also need to complete the classwork test and the password test. When you are finished completing all of these tests, you will be ready to complete session 2. I do recommend that before you complete session 2, you complete the reading assignment for session 1. And as a review, the reading assignment for session 1 is to read IRS Publication 17, pages 4 through 24, and 141 through 143. Thank you, and I will see you at the beginning of session 2. When we begin session 2, we will review the session 1 homework assignment and then take the session 1 quiz. Thank you, and bye-bye.